Hey everyone, this is Daniel um, here for another video uh, doing some analysis on the current stock market um, and see what we can do here. In the last video that I posted on Dow Jones on the general index, I mentioned that the Dow is forming this kind of triangle pattern and the price is consolidating, and we can see the sellers are pushing down, the buyers are pushing up, and it just shows there's a lot of indecision in the market. In my previous video, I did mention that I was expecting maybe the price would, consolidate above the 50% retracement level and then break out to the upside. Unfortunately, that did not happen. Right now, the price actually went down below the 50% retracement level for the Fibonacci, and actually is still being kept down below this level. So I have not made any trades yet. It's very likely that the price could be, it's showing a bunch of weakness here, especially today's FOMC after 2 o'clock. The market actually initially went up, then it got completely rejected right here, right at this level, and then it broke apart at the end of the trading day. And it just tells me that it actually closed below, this triangle area here. It just shows me the market is actually pretty weak, and we could see a potential breakdown from here, right? When the price starts to consolidate and the price range is starting to getting smaller and smaller, that's usually a sign of a major price moves that's about to happen. The market is accumulating energy just like a spring. When the spring is being compressed, and when the energy is released, the energy usually is explosive, and it could be towards the upside or towards the downside. Given the current market condition, this price action, it's quite likely that price could be exploding down to the downside. But in this video, I'd like to talk about something that's even a longer kind of time frame. Something that's been developing for years, which I noticed a couple months ago. So in the previous video, there was another video I posted previously. I talked about the similarities of today's market and 1987. 1987, the market had a huge crash. We had this consolidation area, which I was thinking, which is actually very similar to our 2015 consolidation area, right? If you look at this, we had, I mentioned in the previous video, we had these kind of up and downs. We have the two lower lows here, two bottoms, double bottom. We came up again, and we have this low dip. I don't know what happened here in 1986, but here this dip was formed by Brexit. Then we have this consolidation to November, and this was coupled with the event of the U.S. presidential election. Then Trump got elected in November 7th, I remember, or 6th. I don't remember, but then the market starts to rally. We call that Trump rally. And this actually happened very similar in the 1987 stock market. We have this consolidation. We have this dip consolidation. It almost happened almost exactly the same. It's just the time frame is a little bit different. This event happened a little bit faster than the market in 2016. You can see that this entire event happened in 196 trading days, 196 bars, which is 196 trading days. And this consolidation area is much longer. It's about double the size of that, right? It's 423 days. So maybe I think I labeled a bit long. Too far. So this is 187 bars. There's almost 500 bars. It's like 2.5 times of the consolidation area. And now we're up here. We're up here right now. This is a 48% increase from the resistance zone here. And we have the tip of the market was a 42% increase. 44% increase from the resistance area back in 1987, and that happened in 155 bars, and ours happened in 294 bars, which is about double the time as well. So this is more than double the time. This is more than double the time, and this is more than double the time. So the ratio is actually pretty similar. It's just that we didn't have this middle consolidation area. It's possible that we actually have something like this. We are actually maybe we're in the middle, right? Maybe we consolidate here. We're in the middle. We can consolidate, then break up again. But this area is only 27%. We have 48% increase already. So it's maybe we're at the later stage, because these two stages are very difficult to identify, to differentiate them until after the fact, right? Imagine you're here, you might think it looks pretty similar to today, but this area looks pretty similar to today as well. So it's very difficult to tell whether we're at the second stage or the first stage. However, today I'd like to talk about something called it's called a general price trend. What I call the general path of price in the market. So for every period of market, for every market phases, a long-term market phase, we have a general price trend on the market. What I mean is that, for example, let's put that into weekly time frame, right? So I can take a look at this market and draw something. Just draw a trend line here, right? For example, this market back in the between 1994 and 2000, if I'm able to identify this trend line in the very beginning of the market, it's very beneficial for me, right? Because I know when the price deviates from the trend line, it's kind of overbought. When the price goes down below the trend line, it's oversold. So I can basically having this one line, and I can trade this one line and make a lot of money. And when when away from trend line, I know the market is probably topping, and that was actually not far off, right? When the market was topping, and you could have avoided that bear market here. So what I'm trying to say is that in usually a period of a decade, I think this is also a decade, almost a decade. There's a general trend, general path of price for the market. If you can identify these trends, these major trends, early on in the game, it gives you a huge advantage, because you can sell and buy. You can pretty much sell at the top and buy at the bottom, right? So that's very important. So I'd like to go back to history and talk about 1987. So before 1987, we have very similar condition to 2000. So if you look at this, we have this consolidation, like a long-term consolidation from 2000. Right? And this long-term consolidation area, the market actually went nowhere for almost a decade. That's 802 bars of 5,614 days. Sorry, that's weekly. I was looking at the wrong thing. So that's about 6,700 trading days. The market went nowhere. So if you bought here, and I mean, the market actually broke out after 6,000 trading days, which is a long time. And a similar thing actually happened before the rally of the 80s. And if you look at this, between 1964, I believe, to between 1964, look at that, to 1982, which is almost 20 years. I think many of you who are trading have forgotten this period. This was a great bear market of the US bear market. For 20 years, the stock market went nowhere, right? And imagine a lot of people who were born, start working back in the 60s in Wall Street. For 20 years, Wall Street went nowhere. It's kind of unfathomable today, but it did happen. That's why Wall Street, nobody wants to go to Wall Street at the early 1980s. So if you guys maybe read the books written by Jim Rogers, he mentioned that when he went to Wall Street starting from the 80s, he graduated. And he was one of the greatest investors in the world. But I think he's also really lucky because he joined Wall Street at the beginning of the bull market, right? He formed the Quantum Fund with George Soros, and they were actually right at the beginning of the bull market. So they were really lucky to be there. And if they joined Wall Street earlier on, they probably would have gone broke. Regardless, this bear market went nowhere for 20 years. That's why once the price got out of the bear market, it went completely insane, right? We had the dot-com bubble and the housing bubble. But can we identify the general path of price in the beginning of this bull market? Actually, we can, right? So right after we got out of this consolidation, long-term consolidation range, we can actually maybe draw a line here. And remember, it's like we could draw a line here to identify the path of price. Yeah, so I guess this line could be used to identify the price. If you drew that back in the pivot would happen in 1983, and this line, right? Look at that. It does describe the price pretty well. Okay, not too well. Maybe a little bit. Maybe like this, right? So I mean, it's really difficult to identify these kind of price trends in the beginning of the formation. Sometimes you have to be lucky, But look at this. So if you identify this trend, imagine you identified this, and you can see this consolidation area is confirming that this trend exists. And we can see that when we got out, imagine this is the Earth's surface, and imagine we have a rocket that's going up, and because of gravity, right, it's going to be pulled down. You can see the price is always being attracted to this range for a long time. It went up again, came down, went up again, tried to escape the gravity, came down again, hovering around inside this, went up, came down, went up. You see this is another kind of pretty significant drop. It came down again, but didn't go below that, which is a bullish sign. Then I think at this point, at 1994, after the 1994 recession, it completely took off. Right, it left this behind, and the dot-com bubble burst. The price went back down again. Then we have a housing bubble burst. And interestingly, crazy thing is that it actually, the bottom of the 2008, this is pretty fascinating to me. Even I look at it today, the bottom of the 2009 of the housing market bubble, it actually hits the line we drew, this trend line we drew, which describes the general market trend since 1982. That is pretty amazing, right? We have multiple confirmation along the way. You could be drawing, I mean, you don't have to draw this line here. You could be drawing this line here. You could be drawing this line just using these, right? You can using these ones as a reference. And the bottom of 2000, you could have caught the bottom of 2009 by just drawing that, this obvious trend line, which is very amazing. So I'm pretty sure a lot of big money back in the day, in 2009, probably spot this. This is why they begin to buy. They're buying really aggressively. All the smart money, they probably saw this thing, right? They probably saw this long-term trend, that our price is actually falling to the long-term trend, and there's absolutely actually no risk of buying here. Okay, so can we identify something like that today? Can we identify a general trend of the market today? I think this trend, we've actually escaped from this level now. I don't think we're ever gonna come back and touch it. If it does, that'll be pretty surprising, but I doubt it. I think we have a new trend forming. So where is it? Well, maybe we have something like this. Maybe we have I don't know, something like this. This does describe the trend of 2008 pretty well, right? 2004 to 2008 pretty well. Once the price went below this and closed below this, it fell apart. So you could have gone out here. You saw this thing left the trend, and also the price went too high above this trend. It's being taken down by gravity. The price has to come back down. So this could be a general trend. This is my hypothesis here. And look at that. This trend, this path of price, is actually being confirmed by this consolidation area. Pretty interesting. And as I mentioned previously, the 2015 consolidation area is kind of similar to what we have here, right? So we have, look at this, we have a similar kind of situation here. We have a trend. Imagine this is like 2008, 2004 to 2008, and we have a 2015 consolidation here. We have a 2004 to 2008 here, and we have a 2015 consolidation very similar consolidation area. And now the price has gone way above the trend. Has the price escaped so the question I have to ask ourselves is that, has the price escaped the gravity? This is Earth's surface, right? Has our rocket left Earth? Is this thing gonna reach escape velocity and go to the moon? Or maybe it's gonna be pulling down to the Earth. Maybe it's gonna explode somewhere and be pulled down to the Earth pretty violently, just like 1987. My bet is that we haven't escaped the gravity, right? That's just my bet. I'm putting my money on the line, maybe. We have left this trend line by 40%. And in this case, we have left by 43%, by maybe not 43%, yeah, by 33% from the trend line, from the top of that trend line. And in this case, we have left, went beyond by 40%. So I'm not here to call it crash, but by looking at this, just looking at this long-term market structure, you gotta be, as an investor or as a trader, you gotta be very careful when you gotta be careful about your positions, right? When this thing maybe corrects, it could be correcting very violently, and a lot of people could be wiped out. So we got to be very careful here. Right? It pays to be careful right now because we're in the the 10th year of a bull market, and we have never had a more than a 15% correction actually for the last 10 years, and to have I don't know, from this top to the line would be a 30% correction. Wouldn't be too much a rarity, right? Because we've had these before in history. We had these 30% correction previously, and maybe we're due for a larger correction just by looking at this long-term market structure. So yeah, thanks for watching, and I would say trade safe and trade small. And if you're shorting the market, be making sure you are finding a good entry points. Good luck.